Hello students. So very good evening all of you. In today's session, I am going to discuss AS-10 property, plant and equipment and one of the important standard in CA Inter as well as in CMA Inter also. In CMA Inter first group we have the standard in financial accounting and in CA Inter advanced accounting. Okay. And without wasting the time, I will move on to this topic. And so coming to this, I will upload this material in my Telegram channel, so if you want it, then you can join the Telegram channel. Link is given in the description box, and you can join there. And the important MCQs and case-based scenarios also I will upload there. Okay. And if you are new to my channel, don't forget to subscribe it and also press the like button so that it will reach more number of students. Okay. So coming to the AS-10, property, plant and equipment. And first of all, what is meant by property, plant, and equipment? Nothing but PP. PP is nothing but it is an asset held by the entity, held by the entity, and for a period more than 12 months. So, with an intention to use it, with an intention to use it. So, remember, if any asset held by the entity with an intention to sell it, covered under inventory, if it is held with an intention to use it for what purpose? For production or supply of goods like plant and machinery, and for providing these services, like for example, for providing the educational services, I am using my laptop and cam, so phones. These are all covered under the PPE, and for rental to the others, like for example, so auto company is there and they purchase the autos and providing it on rental basis, there the auto is said to be autos are treated as a PPE to them, and for administration purpose nothing but what furniture. So an asset held by the entity for a period more than 12 months with an intention to use it for production or supply of goods, and for providing these services, or for rental to the others, or for administration purpose are covered under the definition of what PPE. But PPE does not include, coming to the scope, PPE does not include certain items like assets which are covered under another accounting standard like investment property, which is covered under AS-30. And if any asset purchased on this basis, like under finance lease, that is covered under AS-19. The accounting treatment of those assets which are covered under another, which are provided by another standards, are not covered under AS-10. Okay, and another one is biological assets. So remember, coming to the biological assets, coming to the biological assets, it covers two things. One is the live animals, and another one is the bearer plant. And coming to the live animals, it is not covered under AS-10, but bearer plant is covered under AS-10. Bearer plant is covered. And what is meant by bearer plant? So here I provided bearer plant is nothing but a plant, so which is used in production or supply of agricultural produce and expected to bear produce for a period more than 12 months, and it has a remote likelihood of being sold as a agricultural produce except for incidental scraps. For example, mango trees are there, and mango trees are treated as a bearer plant, and because they will provide the agricultural crop, they will provide the agricultural produce for a period more than 12 months, and so they and after completion of the means after certain period, say, so for production of the, for getting the crop, it took around 5 to 6 years. 5 to 6 years. After that, every year we are getting the crop. And those type of trees and which are providing the fruits or vegetables for a period more than 12 months are covered under bearer plant. But remember, annual crops are not covered. And so, like annual crops means, for example, paddy, maize, etc., those are not covered here. And the second one, plants which are specifically cultivated for the lumber or timber purpose, wood purpose, and those are also not covered. For example, red sandal, and those are not covered because those are held for a period more than 12 months, even though those are not covered under AS-10. And another one is wasting. So, coming to the biological assets, Bearer plant is covered under AS-10, but so living animals are not covered. And coming to the wasting assets, and wasting assets like mineral rights, iron ores, so oil wells, etc. Those are not covered under AS-10. Those are not covered under AS-10. Okay. Then coming to the recognition criteria. What is meant by recognition criteria? Simply nothing but the process of recording the transaction in the books of account. When we record the transaction, so how to record it? Those are all covered under recognition criteria. So recognition criteria is done only when it is satisfying the two conditions. One is if it is probable that future economic benefits will flow to the entity and cost of the item should be measured reliably. If these 2 points are satisfied, then we can recognize the asset as a PPE as per AS-10. Then, what is the treatment for spares, standby equipment, service equipment, loose tools, etc.? And remember, service equipment, standby equipments, or loose tools, these all are covered under AS-10, and these are all treated as a PPE only if it is satisfying the recognition criteria stated as per AS-10. If it is not satisfied, then those are treated as inventory and accounted as per AS-2. Accounted as per AS-2. Okay. And coming to the recognition criteria. Generally, there are two types of recognition. Means recognition of that item on the date at the initial stage, like on the date of its purchase, or recognition of that item on the balance sheet date. On the balance sheet date covered under subsequent recognition, and on the date of acquisition or initially, so when we record it, that is covered under initial recognition. In case of initial recognition, always we have to record it at by following what cost model only. Asset PP is always recorded at cost price only. But coming to the subsequent recognition, we have the two model, either cost model or a revaluation model. And in case of initial recognition, so in case of initial recognition, we follow what cost model. What is the cost price of that asset? At the time of recording that asset PPE, what is the cost price? Depending upon whether asset is acquired by paying or agrees to pay cash in future, or asset is self-constructed, or asset is acquired in exchange of another asset. Asset is acquired in exchange of another asset, and asset is acquired through the government grant. And coming to this is covered under AS-12, government grant. Already we discussed in AS-12 when the grant received for purchase of a depreciable fixed asset. So we have two methods. One is reduce it from the cost of the asset, or it may be treated as a deferred income. Then coming to this, here these 3 points we have to discuss. And one is if the asset is acquired by paying or agreed to pay in cash, agreed to pay in cash, then what is the cost price of that PP in that case? Cost price generally includes three things. It includes three things. One is the purchase price. Another one is any directly attributable cost in relation to PPE. And another one is the present value of dismantling or decommissioning cost we have. So coming to the purchase price, while calculating the purchase price, we need to consider what is the purchase price minus trade discount if any, plus non-refundable taxes like GST not eligible for claiming ITC. So those type of things. So non-refundable taxes only included in the cost of the PPE. Purchase price minus trade discount plus non-refundable tax. And remember, cash discount is not considered. Cash discount is not considered because cash discount is not relating to the purchase or sale of the asset. It is relating to the immediate payment or receipt of the cash. So at the time of calculating the cost of the PPE, cash discount is ignored, cannot be considered. And another one, any directly attributable cost, like expenses incurred. So to bring the asset into the available for utilization, those are all covered under what? Directly attributable cost, like cost of material, labor, overheads, if any, we incurred. So, or any installation expenses we have, any transportation expenses we have, and during the 20 toll charges we have, and any professional fees we paid. So, and testing costs. These are all covered under what? Directly attributable cost. And present value of the dismantling cost. This is important. Coming to the present value of the dismantling cost. In case of present value of the dismantling cost means, for example, we purchase the asset on 1/4/2020, and its life is 5 years. Its life is 5 years. And we installed that asset by attaching to the land, and as per the contract with the owner, and we have to dismantle and are required to provide the respected premises in the same manner at the time of we taken to the will hand over to the landlord. Then at the end of the fifth year, we need to restore it. We need to restore it. We have to dismantle that PPE and remain dismantle that PPE, and land will have to be taken over. And while dismantling it, whatever the cost incur, and those are called as what? Dismantling cost. Dismantling cost. But this dismantling cost to be incurred at the end of the useful life of the asset. Then, so, but we have to bring it to the present, like, so dismantling cost into 1 by 1 plus or whole power n. This is the formula. And we need to bring it down. And the present, this is called as what? Present value of dismantling cost, that is included in the cost of the PPE. And while writing the journal entry also, we have to write what? PPE account debited to cash or bank, to cash or bank, and to present value of dismantling cost or decommissioning cost, if any. And here, first 2 points, purchase price and the directly attributable cost only we incurred as of now. But dismantling cost to be incurred after 5 years. To be incurred after 5 years. So that's why we can't consider it as a payment now. So we treated it as a provision. We need to create a provision at present. Provision for dismantling cost to be considered. Provision for dismantling cost to be considered. Say, for example, dismantling cost at the end of the fifth year, say 1 lakh, and R is equal to 10%, then what is the present value of dismantling cost? So 1 lakh into 1 by 1 plus zero point 0.1 whole power n, whole power 5, and total 0.6209. So 1 lakh into 0.6209, nothing but 62,090 rupees. 62,090 rupees. Then we have to consider at what? Initially, at the beginning of the first year, we write the entry PPE account debited to provision for dismantling cost 62,008. I am writing the entry only for provision for dismantling cost. At the end of the first year, we have to add what? Interest. We have to add what? Interest. So, and we write the entry finance cost account debited to provision for dismantling cost 62,090 into 10%, 6,209. What is the amount we have at present? 62,090 plus 6,209. So 68,299. And at the end of the second year, again we charge the interest. So 6,830. 6,830. Then total liability. And at the end of the first year, 68,299 plus 6,830. 75,129. And at the end of the third year, again we write the entry finance cost account debited to provision for dismantling cost. So 7,130, 7,513. And what is the total? Plus 7,513. 82,642. And at the end of the fourth year, again we have to write finance cost account debited to provision. So 8,264. And what is the total present value? 8,264. 9,090,906. And at the end of the fifth year, 9,091 and plus 9091. So 99,997 approximately it equal to what? 1 lakh. Then at the end of the fifth year, we pay the what? Dismantling cost account debited to cash or bank 1 lakh, and that is closed by transfer to what? Provision. So provision for dismantling cost account debited to dismantling cost, say 1 lakh in this way. This is the accounting relating to the provision for dismantling cost. For example, if more or less amount we incurred at the end of the fifth year, that excess amount, if any, or deficit amount, if any, excess amount or deficit amount, if any, and we transfer to profit and loss account. So cost of the PPE includes these three parts. One is purchase price, and another one is directly attributable cost, another one is present value of dismantling cost. For this we have to create what? Provision. Okay. And but cost price that does not include, it excludes what? Certain item: general office and administration overhead, selling and distribution overhead, and cost of opening the new facility, and cost of introducing the new product, and initial operating losses, if any, and cost of training to the staff, along with that cash discount. These cost of relocation of the asset, these are all not included in the cost of the PPE. Okay. Next. And this is one: income earned during the development of the PPE. Income earned during the development of the PPE. And remember, if the income is directly attributable to the asset, then reduce it from cost of PPE. But if it is not directly attributable to the asset, it is treated as income in P&L. For example, so we are constructing the respect one plant and machinery. We are constructing one plant and machinery. And at the time of trial run, at the time of testing, at the time of testing, some goods we produce, and that goods are sold in the market at a lower cost. As a tested product, we are sold in the outside market, and that income is treated as directly attributable to asset and is required to be reduced from cost of PPE. Or else while constructing the building, so during some period we stop the construction, and in that period, during that interrupted period, we provided it on rental basis for the car parking. Then amount of rental we get, that is not treated as a directly attributable to asset, that is treated as an income and transfer to profit and loss account. Okay. Next. Right. So that is relating to the asset acquired by paying in cash or agreed to pay in cash. And next one, cost of PPE. Cost of PPE in case of self-constructed asset. Self-constructed asset means what? We purchase each and every element of the every element relating to the asset, and we are doing construction involved, like material purchase, labor we used, and expenses, etc. So these are all things. So material cost plus labor plus variable overhead and fixed overhead, and initial estimated restoration cost, if any. Initial estimated restoration cost, and for this also we have to use present value of restoration cost to be incurred at the end of the life of the asset. And remember, if any restoration cost is not expected at the time of constructing the asset, like for example restoration cost we expected at the end of second year or third year, cannot be considered. At the time of construction, any restoration cost you expected, the present value of that restoration cost is included in cost of self-constructed asset. And borrowing cost. Remember, borrowing cost is included only if it is satisfying the, if it is a qualifying asset and as per AS-16, otherwise not included. This is the cost. But while calculating the cost of the self-constructed asset, remember, internal profits cannot be included. And internal profit and abnormal losses like any wastage of material or labor charges, etc. For example, during the construction, when strike is happened, and during the strike period also we pay the labor, and that labor paid during the strike period is treated as abnormal and is not included in cost. Depreciation or idle asset, and even already I told you cash discount, etc. These are all not included. Okay, and another one, PPE acquired in exchange of a non-monetary asset. PPE acquired in exchange of non-monetary asset. In case of exchange of another asset, exchange of another asset. In that case, you need to verify whether commercial substance is available and commercial substance is not available. What is meant by commercial substance? And that exchange results in any change in cash flows. Exchange results in any change in cash flows or benefits to the entity. Then that is said to be involving commercial substance. If no change in cash flows or benefits to the entity, then commercial substance is not available. In case commercial substance is not available, then remember asset acquired is recorded at book value of asset given up. Book value of asset given up. For example, car book value 50 lakhs is exchanged with another car of rupees 42 lakhs. And here, no commercial substance we have. Car X and car Y. No commercial substance we have. Then we are getting what car X. Then we write the entry car X account debited to car Y. Then the question is car X is recorded at what price? If no commercial substance involved, asset is recorded at book value. What is the book value of asset given up? 42 lakhs. You have to record it at 42 lakhs. And no need to consider any profit or loss here. Okay. In case of commercial substance involved, commercial substance, there is a change in cash flows. In that case, you have to consider first fair value of asset given up. And what is the second option? Fair value of asset acquired, if any. Sorry, fair value of asset acquired. And remember, third option is third option. So if these two first option, fair value of asset given up, if it is not available, then go with second option. If it is not available, first option, second option, both are not available, we go with third option, book value of asset given up. Book value of asset given up. Okay. So here, for example, one car is purchased whose fair value is 50 lakh in exchange of plant and machinery of rupees, plant and machinery of rupees 38 lakh, and whose fair value is 42 lakhs, whose fair value is 42 lakh. And remember, if it is involving the commercial substance, if it is involving the commercial substance, what is the entry we have to record? Correct, we are getting what core. In return, we are providing what plant and machinery account. Plant and machinery. At what price car is recorded? Here it is involving commercial substance. First option. What is the fair value of asset given up? What is the fair value? Asset given up is a plant and machinery. What is its fair value? Fair value is provided. Nothing but what 42 lakhs. Nothing but what 42 lakhs. But remember, plant and machinery given should be de-recognized from the books of accounts, and the de-recognition should be done its book value. What is the book value? 38 lakh. 38, and the remaining we transferred to profit and loss account. How much amount? 4 lakhs. How much amount? 4 lakhs. Okay. And second one, for example, if the fair value of asset given up is not, if this is not available, then what is the journal entry? Case 2, if fair value of plant and machinery is not available, then we have to write the entry what? Core account debited to plant and machinery account, and car account is considered at its fair value. What is its fair value? 50 lakhs. But plant and machinery should be de-recognized at book value only, and the difference amount transferred to profit and loss account. How much? 12 lakh. And third one, for example, case. For example, both fair values are not available. Both fair values are not available. Then core account debited to plant and machinery here recorded at what price? Book value of asset given up. What is the book value of asset given up? 38 lakh. 38 lakh. And here asset is de-recognized at its book value only. So no profit, no loss involved here. If commercial substance involved, fair value of asset given up is the first option. Fair value of asset acquired is the second option. If both fair values are not available, book value of asset given up is the third option. Okay. I hope you understood. And here, if the PP is acquired in exchange of non-monetary asset, exchange involve commercial substance. This is the order. Fair value of asset given up, fair value of asset acquired, and book value of asset given up. Otherwise, book value of asset given up. If commercial substance is not, it lacks commercial substance. Okay. Then these are the things we have relating to the initial recognition. And some more points we have. For example, if PP purchased for a consolidated price and a group of three or four assets are acquired together as a single package, in that case, the price is apportioned among the various assets in the proportionate of their fair value. If the fair value of each assets are not available or not ascertainable, then the value should be apportioned on fair basis. Value should be apportioned on what? Fair basis. And better to take, and mean fair basis means we take the certification from the expert or valuer. Based on that, we have to divide. We have to apportion it. So if the consolidated price is there, consolidated price apportioned among the various assets in the proportionate of fair value. If the fair values are not ascertainable, then those values are estimated on fair basis by getting the certification from the valuer. Okay. Next, treatment of the subsequent cost. So in case of subsequent cost, if it is relating to the day-to-day maintenance services, then transfer to profit and loss account, just like a regular expense. In case of replacement of parts of the PPE, replacement of parts of the PPE. And remember, if the replacement is of regular nature, it is done at regular interval of the time. For example, in case of Volvo bus, and they are changing the tissues and water bottles they provided regularly, and at the same time, and like a bed sheet, those are changed at a regular interval of the time, and those are treated as a what? Expense and transferred to profit and loss account. Best example, in case of aircraft, interiors such as seats, gallery may require replacement several times during the life of the airframe, and these are treated as what? Expense and transferred to profit and loss account only. And in case of major replacement or major inspection or major overhauling, we have. Case of major replacement or major inspection or major overhauling, we have. For example, I am using the laptop for providing the classes. If the laptop screen has been damaged, then I need to replace it. And the replacement of the screen, yeah, and the replacement of the screen is not done at regular interval of the time. And once in 2 years, once in 5 years, etc. It is happened. That is a major replacement I have. In that case, in case of major replacement, the replacement value should be capitalized. How to consider it? Replacement value should be capitalized. That means, for example, so here the laptop price is say 1 lakh. Laptop price is say 1 lakh, and I provide the depreciation. Say depreciation per annum is 10,000. 4 years I used, so 40,000. 4 years I used 40,000, and total is 60,000. Total is 60,000. And now I am replacing it, and my desktop and my screen was damaged. My laptop screen was damaged. I have to replace it. That is the major overhaul, major replacement I have. In that case, what I do? What is the book value of old screen? Should be de-recognized, and we have to reduce it. And what is the cost to price of new screen? Cost to price of the new screen. And here the book value of the old screen, if you able to complete, and it means out of the 1 lakh, you have to So we have to apportion it. What is the value of this screen separately? From that, you need to provide the depreciation for 4 years and calculate the book value. And the book value is required to be reduced here. And what is the cost you incur to replace with the new screen will be added here. And this is the revised cost we have. Revised cost we have. For example, if the book value of the old screen is unable to identify. In that case, what we do? What is the cost price of the new screen now? New screen now, and this is what expected cost. This is treated as what expected cost at the end of the fourth year, and calculate present value of that expected cost at the end of the fourth year. Then we get what is the present value. What is the value of the screen at the beginning of the 4 years? At the beginning of the 4 years back, and based on that, provide the depreciation, calculate the book value now, and that is considered for derecognition of the old screen. For derecognition of the old screen. For example, I have here is one problem. So here Bharat Infrastructure Limited acquired heavy machinery at cost of 1000 lakhs. The breakdown of its components are not provided. If the breakdown is available, consider it, but it is not available. The estimated life is 10 years. At the end of the year 6, the turbine, which is a major component of the machinery, needed replacement. As further usage and maintenance was uneconomical, the remainder of the machine is in good condition and is expected to last for the remaining 4 years. And the cost of the new turbine is 450 lakh. And here what we have to do first, whether 1000 lakhs is able to apportion it. So he clearly mentioned component wise price is not available. Then ignore it. Then how to calculate? What is the book value of this 1000 lakhs? 1000 lakhs, and we need to provide the depreciation for 10 years. That means 100. How many years we have to provide? 6 years. 600. Then what is the book value now? Book value now 400 lakh. And from this we have to reduce book value of the old turbine. We have to add cost price of the new turbine. But for calculating the book value of old turbine, the source is not available. In that case, what we do? At the end of the sixth year, what is the cost we are spending? 450 lakh. Then calculate if what is the price at the beginning of the 6 years back. At the beginning of the 6 years back, nothing but 450 into 1 by 1 plus. So here the discount rate is provided 0.08 whole power 6 whole power 6. Then we get what? Cost price here. So then we get what? Cost price. So this is treated as cost price of the respected turbine at the initial days. From this, you need to provide the depreciation for 6 years. So overall life is 10 years. So 6 years we have to provide the depreciation, and its book value asset end is 113 lakh. And the total book value we arrived is 400 lakh. So what is the de-recognition of current carrying amount of the old turbine? 113 lakh, 113.43. Then we have to add cost of the new turbine. This is the new or revised carrying amount of the machinery. Revised carrying amount. Okay. So here, in case of major replacement, what we do? First calculate what is the book value of the total asset. From this, you have to de-recognize the book value of the old asset, and we have to add the cost of the new asset. This is revised cost of the entire asset. Okay. This is the treatment of our subsequent cost. And that is, I hope you understood. Okay. And next one. Subsequent recognition. Already I told, in case of subsequent recognition, we have the two models. One is the cost model, another one is the evaluation model. In case of cost model, simply what is the cost of asset minus accumulated depreciation, if any, that is the book value. And in case any impairment loss we have, that impairment loss is also required to be reduced. But in case of revaluation model, and remember, in case of revaluation model, what we do? If revaluation model is opted, then first calculate what is the book value of the asset on the date of revaluation and compare with the fair value of the asset, and the difference is considered and it's accounted as per AS-10. And the fair value of the asset is the revised book value. From that we have to reduce any accumulated depreciation we have and any subsequent accumulated impairment loss we have, that is the book value. But here is the important point. Entity can choose any one of this model. You may follow either cost model or evaluation model. But remember, once you select it, you have to follow it consistently. other, because selection of the model is covered under accounting policy. If you want to change, then the change is applied as per AS-5, change in accounting policy. And the model you selected should be opted for entire class. Entire class. Here, what is meant by class of asset is provide assets of similar nature and similar usage. For example, land and building, machineries, furniture, office equipment. Based on their uses, those are classified. Those are classified into one group. And if you select the respected revaluation model, then follow it for entire group. For another group, you may follow cost model. For another group, again, you may follow revaluation model. For another group, you may follow cost model. For the entire group, you need to follow one model only. Whatever the model you selected, whatever the method you selected, you have to follow it. And for example, in case of the buildings are there. And in building, we have the two classes. One is office building and another one is buildings located in industrial area, which are used as a factory building. Actually, the usage and nature of the office building is different, and usage and nature of the industrial building is different. Then, for office building, you may follow the cost model. For industrial building, you may follow the revaluation model or ulta, depending upon the case. But once you select the cost model for office building, for all office buildings, only cost model is applied. And once you selected revaluation model for industrial building, and buildings covered under industrial buildings class should be applied only revaluation model. Okay. And selection of the model, as we said, it is an accounting policy. And coming to the, and it is subjected to what? AS5. We have to change it, and depreciation will be charged on revalued figure of the remaining period. And so in case of revaluation, how the revaluation is happened? Depending upon whether fair value fluctuations are frequent or not. If fair value fluctuations are very frequent, then revalue the asset at the end of each year. Otherwise, once in 3 or 4 years is enough. At regular interval of time, you may do. And in case of revaluation, how the accounting done? First, calculate what is the book value, and calculate what is the book value, and the book value is compared with the fair value of the asset, and the difference is treated as either revaluation gain or revaluation loss. In case of revaluation, in case of what revaluation, and it results in either revaluation gain or revaluation loss. For example, first time revaluation, if it results in revaluation gain, transfer to revaluation surplus. And if it results in revaluation loss, transferred to profit and loss account only. Transferred to profit and loss. And subsequent recognition. Subsequent second time or third time, whatever may be. Subsequent recognition. First time gain, second time also gain. Then transferred to revaluation surplus. First time gain, second time also gain. Transferred to revaluation surplus. But first time gain, second time loss. Then the decrease in value of the asset, first adjusted, then decrease, is first adjusted to revaluation surplus, and the remaining excess amount of loss, if any, transferred to profit and loss account. First we have to adjust it to what? Revaluation surplus, and the difference amount is remaining excess amount transferred to P&L. For example, first time loss, second time is also loss, transferred to P&L. But first time loss, second time gain, in that case, increase at the second time. First transfer to profit and loss account, adjusted to profit and loss account, and the later we transfer to revaluation surplus. So first time, second time of both are same nature, then transfer accordingly we transfer. But first time is one nature, second time is a different nature. First cancel the first time and then we transfer to the second time nature. So first time gain, second time loss. First we have to cancel this revaluation surplus and the remaining amount, if any, transfer to P&L. First time loss and second time gain. First we have to transfer the amount transferred to P&L. That's why P&L account is a revert back. And the remaining amount we transfer to revaluation surplus in this way. And this is the accounting treatment. And while writing the journal entries, in case of revaluation surplus, so what we do? First, eliminate accumulated depreciation by transfer to PP. Accumulated depreciation account debited to PP. Then PP account debited to revaluation surplus. If it is the first time loss, second time revaluation gain, then PP account debited to profit and loss account to revaluation surplus. Okay. And next. And what we do with revaluation surplus? How to consider revaluation surplus? And the revaluation surplus balance, if any, we have. And revaluation surplus. For example, here book value of the asset 1 lakh and fair value of the asset 1,20,000 and revaluation gain is 20,000 and the remaining life is for example say 5 years are there. Then depreciation should be calculated based on the revalued figure, nothing but fair value. What is the depreciation? 1,20,000 by 5. 1,20,000 by 5. Then how much? Nothing but 24,000 per annum. 24,000 per annum. And this 24,000 generally we transfer to P&L. Like what? Depreciation account debited to PP and the next profit and loss account debited to depreciation account. And this is the process we have. But in case of revaluation, one option is there. One option. This is one option. Don't disturb the revaluation surplus. At the time of derecognition of an asset, when we derecognize the asset, when the asset has been sold or disposed of, or the life of the asset has been completed. In that case, so as if the asset is derecognized, whatever the balance is there in revaluation surplus, so revaluation surplus is transferred to retained earnings. Retained earnings. How much amount is that? 20,000 is transferred to retained earnings because here in this method, revaluation surplus is not affected. Generally, revaluation surplus we show it under the head reserves and surplus as a separate line item and is a specific reserve, special reserve. It is not a free reserve. But up to what date we consider it as a special reserve till the asset is available. Once the asset is de-recognized, we have to eliminate all items relating to that asset, including revaluation surplus. In that case, revaluation surplus balance shifted to the retained earnings. And one more thing. For example, here, additional depreciation is adjusted to the revaluation surplus. Additional depreciation, what is the entry? Depreciation account debited to PPE, 24,000 and next profit and loss account debited, revaluation surplus account debited to depreciation 24,000. But generally, what is the depreciation? 10,000, 1 lakh by 5 years, nothing but 20,000. The 20,000 transferred to P&L. Excess depreciation created because of revaluation 4,000 and that is transferred to revaluation surplus. So, revaluation surplus adjusted with that additional depreciation and any balance we have in revaluation surplus on the date of derecognition is transferred to retained earnings if okay, any balance we have at the time of derecognition is only transferred to what retained earnings. Okay, and this is the one. And next, so that is relating to revaluation and very important topic. Okay, and coming to the depreciation is nothing but what systematic allocation of a depreciable asset over its life. And the depreciation charge should be recognized in profit and loss. I already told you the entry was depreciation account debited to PPE, profit and loss account debited to depreciation. But if you are following the method of creating the provision, depreciation account debited to provision for depreciation, profit and loss account debited to depreciation, this is the one. What is the depreciable asset? Cost minus residual value or scrap value. Case of revaluation model, fair value minus residual value. What is the commencement date of charging the depreciation? The date on which asset came to available for usage. Available for usage. And when the depreciation, so creation of depreciation has been stopped. So the date when which the asset has been de-recognized. Asset has been de-recognized. When the asset is de-recognized, if the asset is retired from its active use, and if the asset is meant for sale or disposal purpose, and one more point is if the asset's residual value exceeds its carrying amount, then asset is shown at zero price or nominal value. In that case, no depreciation has been charged. No depreciation has been charged. So when the asset has been derecognized or when the asset retired from its active use or its residual value exceeds the carrying amount. Okay. And component-wise accounting. AS-10 mandates component accounting for depreciation, and entity should bifurcate initially recognition of amount of PP into significant parts and charge the depreciation of each part separately. For example, aircraft is there. Aircraft life is say for example of 10 years, and its engine part is there. Engine part life is 6 years. Then you have to consider aircraft separately, engine part separately because those are having the different life period and those required to be depreciated separately. That is what component wise accounting. And there are three methods allowed under AS-10, nothing but straight line method, reducing balance method, production units method. In case of straight line method, depreciation is equal to cost minus scrap value by useful life. Here the amount of depreciation is constant throughout the life. And reducing balance method, the fixed rate is applied on the book value of the asset. Production units method, this is the formula. Cost minus scrap value into number of units produced by total expected number of units to be produced. And remember, depreciation method is a accounting estimation, not the accounting policy. It should be reviewed at the end of each year. And change in method of depreciation is considered a change in accounting estimation and is accounted as per AS5 by applying the prospective effect of an accounting. And coming to the land and building, and the land is treated as a non-depreciable asset, building is treated as a depreciable asset. So in case of land, so we can't provide the depreciation provided. If a definite period is specified in case of land, we will provide the depreciation accordingly, just like a regular PPA. Okay. And changes in until like what? For example, one land is there and we are using that land and with the owner we enter into the contract. We will restore the land as usual in a same manner at the time of taking. So then for restoration cost we incur. The present value of restoration cost is treated as a cost of the land at present, and that present value will be depreciated. The present value will be depreciated. Okay. Change in useful life. In case of useful life, scrap value, method of depreciation, anything altered, those are treated as so change in accounting estimation and is accounted as per AS5. Prospective effect of an accounting is required to be provided. Prospective effect of an accounting. Okay. And this is about what depreciation and related concepts we have. And derecognition of an asset is done when carrying amount of PP derecognized only when on the disposal by sale, by entering into finance lease or by donation, or when no future economic benefits are expected from its use or disposal. In that case, gain or loss derecognition of asset should be transferred to what statement of profit and loss. Profit and loss account we have to transfer. Okay. And this is relating to what AS2. And I will discuss some problems here. And coming to Preet Limited intends to set up a steel plant for which it acquired a dilapidated factor having an area of 5,000 acres at a cost of 60,000 per acre, and Preet Limited incurred 1.1 crore on demolishing the old factory. And remember, any demolishing expenses incurred for demolition of the old building where the new building has to be constructed, the demolishing expenses are also treated as a cost of part of the cost of the asset. So, and a sum of 63 lakh, including 5% GST thereof, was realized from the sale of materials salvaged from the site. But any income directly attributable in relation to the asset is reduced from cost of PPA. What is the demolishing expenses incurred? 1.1 crore. From the 1.1 crore, we have to reduce what 63 lakh. But 63 lakh is including 5% GST. But any GST collected at the time of sale will be an output GST and we have to deposit it to the government. So we need to consider what at 100% what? What is the 100%? 63 lakh into 100 by 105. So 60 lakh is there. So 110 minus 60 lakh. We get what 50 lakh is capitalized. And stamp duty we have to incur. And what is the total cost? 5,000 into 60,000. 5,000 acres in 60,000 per acre. And stamp duty total amount into 7%. And so consultancy charges 8 lakh will be added. And so guaranteed insurance, title guaranteed insurance 1.25. So is added. This is the total cost. This in this demolishing expenses is important. Net of salvage income we have to consider. Next. This is the normal problem we have. 23rd. XYZ Limited provided you the following information for the year ended 31st March. The carrying amount of property at the end of a year amounted 2,16,000 and whose cost is 2,50,000 accumulated depreciation 34. On this day, property was revalued and its fair value is 1,90,000. And 2,16,000 minus 1,90,000. There is a decrease in value of the asset. So the difference amount 26,000 we transfer to profit and loss. But the balance in revaluation surplus is 20,000. That asset was already revalued previously, there is an increase. But second time, subsequent revaluation, there is a decrease. In that case, what happened? 2,16,000 minus 1,90,000, 26,000 is there. Out of the 26,000, we have to first adjust it to revaluation surplus to the extent of 20, and the remaining 6,000 we transfer to profit and loss account, P&L account. So here, so what is the total revaluation loss? 26. We have to reduce it from devaluation surplus 20. And remaining 6,000 we transfer to profit and loss. And next, an asset that originally cost 76,000 at its accumulated depreciation 62,000. 76,000 minus 62, nothing but 14,000 and was disposed of during the year for cash 4,000. Then what is the entry? Bank account debited to asset. So how much amount of bank we have? 4,000. But asset value is 14,000. And the difference amount we transfer to profit and loss account 10,000 as a loss on derecognition of an asset or loss on disposal. How much amount loss on disposal of an asset? 10,000 we have to glance. Okay. Next. Coming to the 24th one. Zenith Limited is a medium-sized manufacturing company engaged in production of precious industrial components has provided the following detail. You are required to calculate depreciation in accordance with AS-10. Machine was purchased on 1st April for 10 lakh. The management estimated useful life is 5 years. Residual value is based on 2020 prices is 10 lakh. So that means cost is 10 lakh and residual value 10 lakh. Life of the asset is 5 years. Then depreciation is equal to what? 0. So no depreciation is provided. Okay, no depreciation is provided because there is no depreciable amount. Second one, company owns a piece of land acquired 50 lakh, which is being held for use in its factory operation. But the land is having the infinite period. So no depreciation has been charged on second item also. Zenith Limited constructed a machine for its own use at a total cost of 5 lakh and the construction was completed on 1st April. Machine has been used for life of 10 years. However, the company didn't commence using the machinery till 31st March 2025. Even though, remember, depreciation will be charged from the date on which asset came to available for use. Nothing but 1st April 2024. That on that day construction was over. So for the current year, you need to provide the depreciation. 5 lakh by 10, 50,000 depreciation should be charged on 31st March 2025. So we have to charge the depreciation of how much? 50,000. And another machine was purchased on 1st April for 50,000, having the life 5 years, nil residual value. Subsequent on 1st April 24, the management decided machinery would now be used for only 22 more years. First, in case of change in useful life, first calculate what is the book value. So 50,000 by 5, 10,000 per annum. How many years? 22, 23, 23, 24. 2 years. So 20,000. What is the book value? 30,000 is the book value. And the revised life is another 2 years. So the depreciation per annum from now onwards 15,000 per annum. Okay. So the revised book value by remaining useful life. Okay. 15,000 per annum. This is the one. Okay. Hmm. Coming to the 21. Precious Tools Limited provides the following details relating to fixed asset for the year ended 31st March. The company purchased a machine for 12 lakhs and the following on 1st October, following expenses income. So freight will be 12 lakhs plus freight will be added, directly attributable cost. And erection charges 40,000 is a directly attributable cost. Testing cost. Testing cost is almost 25,000 plus 10,000, 35,000. But sale of finished goods from testing. If any income we have directly attributable to the asset, will reduce it from the cost. I think but 25 plus 10, 35,000, 35,000 minus what is the sale proceeds of testing material 8,000. So that is required to be read. Net of the sale price we have to consider. Net of the sale price. This is the cost. So on 1st October 2024. This is the second one. On 1st December, it replaced the motor of old machine with a new machine, new one costing 1,20,000. This is to be capitalized. We added to the cost of the asset. And the old motor cost is 50,000, accumulated depreciation 35. So 50 minus 35. 15,000 has to be derecognized. Old machine book value has to be derecognized. New machine book value, new machine cost price will be added. Next. On 15th March 2025, company shifted machinery from one factory to another factory. Nothing but what relocation cost. Remember, cost of relocation is a expense or transfer to P&L, not to be capitalized. Entire amount an expense and not to be capitalized. So capitalized part is this one and this one. Okay. So this is the one, and these are the important problems we have relating to AS10. Okay. I hope you understood. And again, I'm telling you, and I will upload this material in my Telegram channel and join the Telegram channel. There you can download it. And also, I will provide some MCQs and case based scenarios there. Okay. Thank you. Bye.